Hello and welcome to episode 34 of Ask a Property Manager. Today is August 19th, 2020. We're coming to you live from Studio 2.0 here at Own Buffalo. I'm Andrew Schultz, principal broker of Own Buffalo Inc. And on today's show, we're going to be looking at a new fee that you might wind up paying on your next mortgage refi, where people are moving to as a result of shifting markets, and we're going to be answering some questions from landlords around the country. Before we jump into that, we're going to plug our social media. New episodes of Ask a Property Manager drop every Wednesday, 10 a.m. Eastern, live on our Facebook page, facebook.com/Buffalo Foreclosed Homes. Later that same day, you can catch the replay on our Facebook page and also on our YouTube page. You can find a link to that over on our website at ownbuffalo.com. Last but not least, don't forget that you can grab a free 30-minute phone consultation or Zoom consultation with me over at ownbuffalo.com. We do still have a couple of time slots available this week, as well as a few open time slots available next week. Last but not least, don't forget about the Rent Prep for Landlords podcast. That drops every Thursday morning. So if you're watching this live, that'll come out tomorrow morning, probably before you've rolled out of bed. This week's episode is pretty interesting. We're going to be discussing a tenant that actually stripped the rental right down to the studs. We're going to be talking about the best online payment options for landlords and how to handle odd requests from tenants. So don't miss out on that episode. New episodes of the Rent Prep for Landlords podcast drop every Thursday morning, anywhere podcasts are heard. You can also find that over at rentprep.com/podcast. Guys, we're going to jump right into our first news story today. This is published by CNBC on August 13th, so this is last Thursday, written by Diana Olick, O-L-I-C-K. Hopefully I'm not mispronouncing that. And this is actually pretty interesting, and it's a current news event, so I wanted to make sure that it got some coverage here. Again, this was posted by CNBC, titled "Mortgage Refinancing Will Be More Expensive as Fannie Mae and Freddie Mac Raise Fees." So this is all in regards to refinance mortgages. This won't have an impact on a first mortgage, or if you're going in and purchasing a property, this won't be applied to that mortgage. This would be if you already own a property, you're trying to do some kind of a refinance. Consumers will have to pay more to refinance their mortgages after Freddie Mae and Fannie Mac announced that they will be raising fees for lenders on the loans. The change is designed to shield the two entities from the additional risk brought on by the coronavirus pandemic. In a letter to lenders, Fannie Mae specifically cited market and economic uncertainty resulting in higher risk and costs. The price adjustment adds a 0.5% of the loan amount to the consumer's cost. That amounts to $1,400 on the average mortgage originated today. It'll begin in September, which means it basically will apply to all refinances that aren't already in progress. After we go through this article, I'll show you what this math looks like for a typical South Buffalo duplex. The move was met with strong criticism from the mortgage industry, seen as a slap in the face of one of the sectors of the economy that has been thriving during the pandemic. This announcement is bad for our nation's homeowners and the economic recovery, wrote Bob Brokeschmidt, CEO of the Mortgage Bankers Association, in a statement. Requiring Fannie and Freddie to charge a 0.5% fee on refinance mortgages they purchase will raise interest rates on families trying to make ends meet in these challenging times. Mortgage refinances have been resurging for months as interest rates continue to set record lows almost weekly. Borrowers today have a good amount of equity in their homes due to high home values and a conservative mindset among consumers since the housing crash more than a decade ago. Consumers have been able to not only save on their monthly payments through refinances, but also pull out much needed cash during these difficult economic times. Banks have also made hefty profits off all the activity. Fannie and Freddie don't lend to consumers, but they buy the loans from lenders and package them into securities, which are then sold to investors. The entire movie Big Short revolves around this. If you haven't watched that, definitely give that a watch. They then guarantee the principal and interest on the loans in the event of a default. Fannie and Freddie have been highly profitable lately, with a combined second quarter gain of $4.3 billion according to earnings statements. The Federal Housing Finance Agency, which regulates both, is in the process of moving them out of their 11-year tenure under government conservatorship, which would require them to raise sizable cash. The move, however, appears to fly in the face of other actions to help support the housing and mortgage markets. At a time when the Federal Reserve is purchasing $40 billion in agency MBS, mortgage-backed securities, per month to help reduce financing costs for mortgage borrowers to support the broader economy, this action raises the cost and undermines the Federal Reserve's policy. They also added It could have political repercussions. This is negative for the economic recovery, negative for the housing market, wrote Janet Seiberg, housing policy analyst at Cowen Washington Research Group. It also exposes President Trump to charges that he's trying to tax housing at the height of the economic crisis. That is a political liability for the president, and we expect the Democrats will exploit this. The bigger concern is whether the move was done because the FHFA is increasingly worried that Fannie and Freddie could face huge losses when the mortgage bailout program ends and borrowers have to start making their payments again. The programs were instituted in April and ballooned to far more borrowers than the FHFA director, Mark Calabria, originally predicted. There are currently just under 4 million borrowers in government and private sector mortgage forbearance programs. These allow them to delay their monthly payments for up to a year. The increase in fees was only levied on mortgage refinances, not on loans used to purchase a home. Rates are higher for refinances, noted Matthew Graham, Chief Operating Officer of Mortgage News Daily. FHFA sees that and concludes that lenders have money to give on refis. It's a tax based on jealousy, greed, and probably more than a little bit of disdain. So that's pretty much the article in its entirety. The price adjustment adds a 0.5% of the loan amount to the consumer's cost. So let me grab my calculator real quick. So we're going to say that you bought a property down in South Buffalo. We'll buy a duplex in South Buffalo several years ago before the housing market really started to pick up in that neighborhood, and you spent $50,000 on the property. The property's now worth, we're going to say, $150,000 conservatively because you've kept up on the maintenance and the market's improved. So we're going to say that house is worth $150,000. The bank is going to give you a cash out refinance of probably 75% loan to value. So they're going to give you that mortgage in the amount of $112,500. As part of your origination fees, you're going to have to pay an additional 0.5% in closing costs, totaling $562.50 on that loan, in addition to all the other fees and origination costs that go into that loan. So essentially, they're putting an extra 0.5% on every single loan, every single refinance loan that's being put out there, which it's basically just to offset the risk. It's exactly what the article mentions, that they're doing it to offset additional risk brought on by the pandemic. And it's, there are higher risks and costs right now. From what I've seen, I did read another article separate from this. I won't be covering that one this week. But I did see something that had indicated that most of the people who are coming out of forbearance programs are able to start picking up and making their payments again. Well, I guess we'll see what happens as more and more people come out of those forbearance programs. I think that you're going to find that a lot of the people who are in forbearance hopefully are going to be the same people who are back to work in a lot of instances. I mean, unemployment is still very high in the country, so we do have a lot of concerns there to keep in mind. Hopefully, this isn't as bad as what it looks like, but anytime you start talking about adding new fees to offset risk, when you're talking about somebody who's doing a refinance transaction, you're looking at that individual and deciding that they're low enough risk to make that loan, and you're basically using them to offset the risk of everybody else. I guess it's really no different than an insurance company. You're paying your health insurance premium on the hopes that you never need your health insurance, but when your health insurance, when you do need it, you hope that your health insurance pays out, kind of a thing. So that's kind of the way I take this. Do I agree with it? No. Anytime there's an extra fee that's added for the sake of adding a fee, I'm not a fan of it. This is published by Housing Wire. This was published on August 17th, so just a couple of days ago. The article author is Julia Falcon. New interest from city dwellers raising home prices in rural areas. And the reason that I wanted to bring this up is that we are seeing, especially here in the Buffalo market, where things are already increasingly tight. There's not a lot of inventory in our market. We're starting to see people from urban markets such as New York City, Chicago, Los Angeles, maybe people that have called Buffalo home and moved out to bigger cities and things like that. There's a lot more flexibility in the world right now, it seems, in terms of work from home opportunities and things like that, where we're seeing a lot more people are leaving the large cities and looking for something a little bit more suburban or a little bit more rural. And that's kind of what this article delves into. The pandemic is pushing homeowners out of big cities and into rural and suburban areas, pushing up home prices in previously sleepy towns. In July, less densely populated areas showed more buyer interest than urban areas, according to Redfin. Before the pandemic, 9% of home buyers said they were searching for homes in rural areas. Now 19% say they were looking at rural options. That's a pretty big jump. That's a 10% jump in essentially a month. Um, I guess it'd be more than a month because it says before the pandemic. So we'd have to be looking back at like January, February. The median sale price of homes in rural areas increased 11.3% year over year in the 4 weeks ending August 2nd and rose 9.2% in suburban areas, while homes in urban areas had a smaller home price increase at 6.7%. So that is worth noting that you're seeing more growth in suburbs and rural areas than you are in urban areas, at least in terms of home price. We've been speculating about increasing interest in the suburbs and rural areas since the start of the pandemic, said Redfin economist Taylor Marr. Now we're seeing concrete evidence that rural and suburban neighborhoods are more attractive to home buyers than the city, partly because working from home means commute times are no longer a major factor for some people. So pretty much tying into exactly what I said, when you have that flexibility and freedom to work from home, why not take advantage of it? As a result of COVID-19, 13% of home buyers had searched for homes in a different area than originally planned, according to a Redfin survey conducted from July 19 through 21. Before the pandemic, 37% of home buyers said they were looking for a home in an urban area compared to 19% now. The number of home buyers looking in the suburbs also grew. 43% said they were looking for a home in the suburbs before the pandemic, and 50% said they are looking for a home in the suburbs now. Home supply in rural areas went down 37.9% year over year and down 31.8% in the suburbs over the 4 weeks ending August 2nd, compared to 21.3% decline in urban areas. And what that essentially means is properties in rural areas are moving faster than properties in urban areas, essentially. So meanwhile, the new listings in rural areas fell 14.2% year over year, lack of inventory, and dropped 3.6% in suburban neighborhoods, lack of inventory. In urban areas, new listings remain flat year over year, about the same amount of inventory. Typically, I would expect there to be more inventory in the urban areas when you start looking at people who are moving from urban areas to out of the area. I would expect that you would see more urban inventory available, but that might just be something that starts to occur a little bit further on down the road. But this is definitely going to be, the way things are for at least the next little period of time here, as people figure out what their new normal is or whatever the case may be. This is one of those situations where if somebody has the opportunity where they can do a work from home or something like that, they don't necessarily need to go to the office every day. Maybe you don't need to be in the big city where the office is located anymore. We've been talking about... For years, we've been talking about the possibility of a high-speed train in our region that would run from, speculative, from maybe Toronto, Buffalo, Rochester, Syracuse, Albany, and then downstate New York City, or Toronto, Buffalo, Philadelphia, or Pittsburgh, something like that. And this might just be the new high-speed train. It just doesn't look like a train. It just happens to take the form of work-from-home opportunities for some employees, and maybe that's kind of the change that we're going to be seeing here moving forward. Is companies that have headquarters in New York City will start to understand that it's a lot less expensive for them to have remote employees because they don't have to carry the very expensive office space in New York City. In addition, they don't, the employees don't have to spend money on coat closets in New York City to live in when they can have an actual residence and home outside the city at a significantly reduced price. So definitely something to keep watch of over the course of the next little while here as the markets kind of change as part of this whole global situation. So let's jump into our landlord questions, and this time I wanted to actually start with some good news. This was posted at the end of last week, and all of these were pulled from the Rent Prep for Landlords Facebook group. You can find that over at facebook.com/groups/rentprep. Be sure to answer the questions so that you get access to the group. That's just shy of 12,000 people from all over the country. Everybody's got a little bit different perspective on how to manage rental property. You can go in there, ask a question, and get a ton of different perspectives. So it's definitely a good free resource to tie into. Anyway, back to this. Perfect end of the week. Just got a 3-year lease property back in turnkey condition. I think this may be my 4th or 5th one in 20 years. That's awesome. It's so nice when we get rental property back in the condition that we gave it to the tenant. And if you're a tenant and you happen to be watching the show, I'll let you in on a little secret. The best way to get the most of your security deposit back is to turn the place over in good condition and clean it. Please just clean it. Landlord references. What do you do when previous landlords don't pick up the phone or don't return your calls? How much time do you give before you either give up on the applicant or move forward with the lease signing? I had a good luck with contacting previous landlords in the past, but this time I'm having trouble. They don't pick up their phone. Everyone is sent to voicemail by default. This is a large apartment complex. Thank you. Few things that can be looked at on this. So the first thing I do is I tell the applicant to call their landlord and tell their landlord that they need to get in contact with us. Put it back on the tenant. Tell them that we can't move forward with your application until we have your landlord reference. The other thing we do is when an applicant applies for an apartment, we tell them up front the landlord reference is the longest part of the process, almost always. If they can jump in and make a phone call to their landlord to call us or to know that we're calling, that helps to move the process along a little bit. You do mention that this is a large apartment complex. Chances are they have a procedure in place for this where they're going to require a signed release in order for them to give you any information, to make sure that you have that available to you. We actually include it. It's actually the bottom of our rental application is the release that the tenants will sign. And that gives us the authorization to go to their previous landlords and request information. And it gives the landlord the permission to release that information to us. Basically, the tenant is signing off, authorizing them to give us that information. So if another thing I had thought about with this is if the landlord is not calling you back, it could be a red flag because they don't want to give you a bad reference. So they may just be ignoring the situation, hoping that you go away and that they don't have to put out a bad reference. Not necessarily the right thing for a landlord to do. I mean, if it's a bad tenant, it's a bad tenant and you're going to want to know about it. But this is one of the reasons that we tell people to make sure that you're checking multiple landlord references whenever possible. And the reason I say that is because you may be calling their most recent landlord who may have an axe to grind and may want this tenant out, and they will tell you whatever you want to hear if it means that this tenant is going to be out of their unit. You might want to look back, not to the most current landlord, but the landlord prior to that. And we request 2 years, at least 2 years of residence records when we take a rental application. You might want to talk to the landlord prior to the most recent and see if they have a little bit different story now that the tenant is out of their unit and it's been a little while since they've been removed. If you check credit, which you should be doing, if you run a credit check, one of the things that a credit check will give you is a list of addresses associated with that person's social security number. Verify those addresses against the rental application as well and against the ID card as well to make sure that they all match up. And if there's an address that doesn't appear anywhere, ask the tenant about that address and see what the response is that they give you. We have come across, some stuff in the past where just by digging a little bit deeper, we've found where a tenant just completely excluded a tenancy that they were evicted from. And while we can't look at eviction data here in New York any longer, we uncovered it in a roundabout way just by looking and saying, well, what is this address here? And the tenant voluntarily withdrew their application because they didn't want to fess up to the fact that they'd been through an eviction. So that is something to keep in mind. Check out check the addresses that are coming across on your credit check as well. The other thing you can do, you mentioned that this is a larger apartment complex, but a lot of times for smaller landlords where it's a single family or a smaller multifamily, I'll look at the tax record and compare it to the landlord's name on the application and see if it matches. Because a lot of times you'll have somebody that tries to sneak through a fake landlord reference with a friend or family member. And when you look at the tax record, it's just a complete and total mismatch. And then when we're doing our actual phone calls, our landlord verifications, we'll ask that person purposely wrong questions. So if the person says that they're paying $900 a month in rent now, we'll call and say they said that they were paying $750 in rent and see if the person corrects us. And the other thing that we'll do is we'll ask them if they own or if they manage the property and see what the answer is that they give us. Those are just a couple ways to kind of flush out falsified landlord references and things like that if you suspect that there's something kind of going on there. So that's my little rant on landlord references. Hopefully that helps. That's definitely one of those things. Landlord references are becoming a little bit more difficult to come by. We all need to help each other out there as housing providers. We have to help each other out. Those references are critically important to all of us. So give references, be truthful in your references, and before you give out your reference, make sure you have a copy of the signed release in case the tenant ever comes back and says, well, why did you say that about me? All right, disclosing lead paint. How do you handle renting a home after it's tested positive for lead, but the specialized lead contractor fixed all cited issues? We always include the lead paste paint pamphlet with the lease. Do we have to disclose more now? So I'm actually going to pull up a copy of our lead-based paint form here for the state of New York. And you could type in the property address here. We'll just go 123 Main Street. And we're going to say it was built prior to 78. So the way that our booklet, or I'm sorry, the way that our disclosure works here in New York is the lessor has basically two questions that they have to answer. If there's presence of lead-based paint or lead-based paint hazards, this I believe you could check no because you have no knowledge of lead paint or lead paint hazards in the housing because it's been remediated. I could also see the response being yes and saying remediated issues in X, Y, and Z areas. Report attached. Normally I can type a little bit better than that. Records and reports available to the lessor. Lessor has provided the lessee with all available records and reports pertaining to lead-based paint. So this is where you would want to provide both the initial testing as well as the remediation report showing that all of the lead-based paint has been remediated. This is one of those situations where I would over-disclose. Anytime you're dealing with like a lead paint concern, you've already done the hard part. You've already done the lead paint remediation. That's the hard part. That's the expensive part. Handing somebody a piece of paper that says, yes, we knew about lead in the property, but it's been remediated, and asking them to sign off on it, that's the easy part. So don't put too much stress into this. Yes, go ahead and, I'm going to say go ahead and answer yes on both questions. Attach the reports that you received as a result of the remediation work, because you'll have the sign-off testing from after the remediation work is done that you can provide, showing that the property is now lead-based paint-free. The lessee will acknowledge that they received a copy of this form and all of the information above, as well as a copy of the Protect Your Family from Lead in Your Home booklet. You have to provide this when you do your lease. It's very straightforward. You can download a copy right off the EPA's website and print it out. You don't even have to buy it. I don't remember how many pages it is. I want to say it's like 20 pages. I think that we print it like 3 pages per sheet or something like that. And then if you are working with a real estate agent or a property manager, they're going to initial on that, and then all 3 are going to sign down at the bottom. So let me jump back to that question. That's basically what I would do in terms of disclosing lead-based paint. I'm always a fan of over-disclosing rather than under-disclosing. It's a lot more difficult to find yourself in hot water if you over-disclose on something than if you under-disclose and somebody calls you out on it. So definitely don't screw around with this. Make sure you're disclosing as much as possible. Talk to an attorney in your state that can give you a little bit clearer response than what I gave. They may have different instructions for you, but if I was put in the position that you're in, I would answer yes on both questions and just provide all the documentation. Like I said, you've already done the hard part of making sure that the lead paint has been remediated. You've already done the expensive part. Now you just have to make sure that everybody's aware of it when they decide to rent from you. Moving right along to closing concerns. I am currently in contract to purchase a 4-plex in Connecticut, and all of the units are occupied with tenants. They currently all reside month to month because the leases have expired, and also all tenants are paying at least $250 less than market value in the neighborhood. I am willing to keep the tenants. I asked the seller to provide me each tenant 6 months proof of rent payments, a credit report, a background check, and employment history. The owner refuses and insists that they're good tenants, does not want to scare them away by asking them for these things. Am I wrong for asking for these basic requests? So I've got a couple of thoughts here. The first thought is the owner should have that information, maybe not the most current information, but if they screened the tenants when the tenants were moved into the apartments, then the owner should have most of that information anyway. All of that being said, you're asking for a bit much in my opinion. I would go ask for a tenant ledger. A tenant ledger would be nice because that'll give you a clear indication of when the tenants have been making their payments and whether the payments have been on time or not. That can be verified by having a forensic accounting analysis done to verify that the money's actually flowing into this guy's bank account the way that he's reporting that it is. So a tenant ledger, yes, that's probably appropriate. Forensic accounting on a 4-unit, probably not necessary. I don't know too many people who are going to open up their bank accounts for a 4-unit, but it could be verified via bank records if necessary. More important to me than the credit report, the background check and stuff like that, the employment history, we don't provide, like if somebody takes management of a property over from us, we provide them with essentially a move-in report and any photos that we have from the move-in. They don't get the rental application, the credit check, the background check. None of that information carries over to the new person, partially for legal purposes. By law, we're not allowed to transmit the credit and background checks to anybody. And the application is considered, the tenant's private information as far as we're concerned, that they disclose to us. So we choose to protect that. We don't provide any of that information when somebody takes over management or purchases a property. But what we will provide is a tenant ledger showing whether or not they're current. We'll also provide the move-in photo set if we have one, as well as a move-in sheet, which is good information to have. That'll help them when they go to do the move-out inspection so they can tell what's been damaged or what has not been damaged. So I don't think that you're going to get the credit report, the background check, the employment history. I think that what you're asking for is a little bit of overkill, in my opinion. There's other ways that you can approach it. Something else that you might consider is an estoppel certificate signed by each tenant. And essentially what that does is it highlights the key points of their tenancy. So it'll verify their monthly rent is X dollars, it's due on X day of the month. We have a security deposit of X number of dollars. Maybe you'll want to include the names of everybody, any appliances that are included, if the tenants are responsible for any services like lawn care or utilities or anything like that. It's almost basically just like a summary of the tenancy that the current landlord and the current tenant can both sign on. And that becomes a legal document. It becomes part of your closing. And basically what that's doing is certifying that the information that you're being provided with is correct. The other thing that you can do, I'm going to pull up a rental property writer here real quick and switch back to desktop screen. So this is one of the forms that we use here in our market. It becomes part of the contract, actually becomes part of the listing agreement, which then becomes part of the contract. And what this is, it's called a rental property rider. And essentially what you do is if you've got 4 apartments, 1, 2, 3, and 4, you would list the names of the tenants, the monthly rents, the security deposits, if they have any advanced rent paid, if they're on a month-to-month tenancy or if on the lease, what utilities are included, what appliances are included. This is a pretty good place to start drawing information about the property from and about the tenancies from, especially if you have expired lease agreements and stuff like that. This is a nice little summary that puts everybody on the same page as far as what is going on. I would back this up with an estoppel if I felt that there was something going on the back end, that I was being lied to or whatever. I would request that this be backed up with an estoppel. The estoppel being, tied into the transaction, that again becomes another legal document basically saying, okay, you've now signed off, the property seller has signed off on a rental property rider and on an estoppel certificate, and the tenants have signed off on an estoppel certificate agreeing to all of these terms and conditions as well. So that's probably the way that I would handle it. Whoops, let's pop that off the screen. If I was put in that position. As far as getting a copy of the credit and background checks, I think you're asking a bit much. I don't think you're going to get that. That pretty much wraps us up here for today. Thank you so much for joining us. New episodes of Ask a Property Manager drop every Wednesday, 10 a.m. Eastern, live on Facebook. You can catch the same thing on the Facebook channel later today as a replay, as well as on our YouTube page. You can grab a link for that over at ownbuffalo.com. New episodes of the Rent Prep for Landlords podcast drop every Thursday morning. Don't forget to check that out. And don't forget that we also have an Instagram where we post a little bit different content than what we would post on our Facebook and on our YouTube pages. So that's definitely something that's worth checking out as well. I believe the most recent post on our Instagram page was from the end of last week when I was out at one of our new foreclosure assignments and found some squatters in the suburbs. So you'll want to double check that out. It's a good time. Thank you so much for watching. I really do love producing Ask a Property Manager, and you can definitely help us improve. Drop a question in the comments either on Facebook or YouTube, and your question may be picked up in an upcoming episode. If you enjoyed this content, or if I brought some value to your day, please do me a favor and hit that thumbs up button. YouTube and Facebook both push videos based on community feedback, so every like, comment, subscribe, and share helps us to grow and reach more people. Next week's episode will be live August 26th. That's next Wednesday at 10 a.m. Eastern. We'll be back with another show you don't want to miss. Thank you all so much for watching, and we'll see you next week.